Hello investors, today we'll discuss on the debt market outlook and advantages of investing in the fixed maturity plan. In the recent week post lockdown due to the COVID-19, yields across the curves have witnessed volatility. Now there are various negative and positive factors. On the negative side, the concern regarding the higher fiscal deficit, higher supply, continuous offloading by the FPIs and FIIs, and lack of appetite from the other market participants leads to the negative impact on the yields. Whereas on the positive side, RBI has taken various measures in terms of easing of the policy rate, cut of CRR, infusion of additional liquidity by way of targeted LTRO, and OMO purchases. The inflation number, which has eased to the level of 5.91 from the highest of 7.40, and further expectation of the lower easing of the number would have positive impact on the yields. Further, market is also expecting that RBI would come out with certain positive measures by further easing of the rates, maybe additional infusion of liquidity by way of LTROs, OMO purchases, or maybe direct participation in the GSEC options. However, there are negative factors which are also playing in the market in terms of concerns on the higher fiscal deficit, higher supply of GSECs and SDLs, depreciating rupees, etc. So this has led to all these factors have led to the widening of the spreads on the GSEC and GSECs, HDLs and corporate bonds. For just to illustrate, the 3-year GSEC is trading in the range of at a spread of 100 basis points, whereas the 10-year is in the 200 basis points over the policy rate. Whereas for the PSU AAA corporate, the same spread is in the range of 180 to 200 basis in the 3-year, whereas it is in the range of 300 basis for the 10-year segment. So on the backdrop of this kind of volatility in the yields market, and to avoid this volatility and to take the advantage of the higher spread, we are suggesting investors to invest in the fixed maturity plans offered by the mutual funds. Now why fixed maturity plans? Fixed maturity plans, popularly known as FMPs, are having a fixed tenure which is ranging from few weeks to few years. However, over here we are primarily discussing the FMPs with a tenure of 3 to 3.5 years and having an underlying portfolio of highest rated corporate bonds, that is triple rated corporate bonds, GSECs and SDL. So this is the best avenue available for the investors with a low risk appetite, and the investors who are really apprehensive to invest their surplus into the products other than banks fixed deposit and the government small saving schemes. Now, why this is the best avenue is, number one, this is a very simple product to understand. The underlying portfolio would consist of around 10 to 12 securities issued by issued by the highest rated corporates, GSECs and SDLs, aligning with the maturity of the scheme. Generally, fund managers follow buy and hold strategy, which reduces the scheme expenses because of the negligible churning, and the post-tax returns are relatively higher because of the indexation benefits available to the investor. So these products is really suitable for the corporates, HNIs and retail investors who wish to avoid interest rate risk and to completely eliminate or to completely intend to eliminate the fluctuations of the returns due to the mark-to-market components. So we are suggesting investors to allocate certain portion of their investable surplus in the FMPs in the tenure of 3 to 3.5 years, wherein the underlying portfolio would consist of the highest rated corporate bonds, SDLs and GSEC. Benefit of the higher spreads available at this moment, and to avoid the volatility in the yields. Thank you, investors. Stay safe and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.